The share market might feel very scary and volatile and risky, but then when you know what to look out for, it just gives everybody a peace of mind that when they're now investing, they're not gambling. You're actually following a very systemized process that I've used for 30 years. 700 plus farmers have been using for the last 10 years as well. And just knowing that there's this process-driven approach that it needs to tick all the boxes. And if it doesn't tick the boxes, there is enough investment opportunities and cycles that you can miss out on this opportunity and don't worry about it, and not have that FOMO. And at the same time, whenever people down a track, their friends and family are like, when they give them tips of certain investments, certain stocks, certain shares, then now within 30 seconds, you've got this confidence to literally look at the numbers and just go, yes, it's for me to further investigate, or no, it's not. It just does not make sense financially. Like the numbers just don't make sense and you can let it go.
Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. G'day everyone. I hope this finds you incredibly well. As we launch into 2026, it's been a diverse and varied year for many. I know here we've had our second year of fairly tight dry, and it's been interesting before the Christmas break to get a read on the grain market with Brett Stevenson, to get a read on the wool market with Endeavour Wool, to get a read on the red meat market with Simon Quilty. And it's interesting to see their predictions around how our commodity markets and input markets are going to influence Australian agriculture and our terms of trade, if you like, over the next 12 months and beyond. So if you haven't listened to those, I encourage you to listen to them. But as we launch into 2026, and given if we watch the media, all the hype that is going on, perhaps with some of the exciting comments and narrative that Trump administration are putting out there, if we listen to the media, we might be concerned and alarmed. And so I thought, again, as we kick into the new year, that it's timely to call on my good friend and founder at Freedom Trader, Terry Tran, just to give us a read on the global marketplace, the global equities markets, and what's actually happening around the world from an investment perspective. Terry, it is always fantastic to catch up with you and look forward to your view on how things really are out there in the wide world. How are you?
Very well, Jeremy. So always glad to be here as well and add value to our farmers that's listening and see what I can do to help out.
Terry, as I mentioned in my intro, if you watch the media and you listen to the hype, the world is a bit of a crazy place. What's really going on?
I always look at the data behind the scenes. So, the media is one thing that allows you to see, what's being portrayed and therefore what reactions are expected. But then the data, which, for example, for me, it's a share market, and therefore the share market are global businesses, global companies, the likes of Google, Facebook, etc. So I look at the data and how are these companies still performing despite all the challenges, and also at the same time seeing what's actually behind the scenes in terms of banking liquidity and finance. So is money still flowing around, free flowing around the world? And if it is, then the market is actually still okay, despite all the negative headlines. And hence why, since we last spoke 6 months ago, the market has actually bubbled up another 10 more %.
So can we just touch on that, Terry? 2 questions. What has happened since we spoke sort of 6 months ago, and what's happened over the last 12 months? And then second question is, how has your portfolio and some of your members' portfolios performed?
Yeah. So since we spoke, obviously Trump got re-elected back into power. He was 6 months. He was at that time a few months in. And since then, despite all the things he's been doing to potentially destroy long-term relationships, global relationships, that is, and we're seeing that play live, especially in last month when he was at Davos in Switzerland with that Global Economic Forum. And so politically, we're seeing that long-term relationships and all the different allies, all that is getting long term, I think it's getting destroyed relationship wise. A lot of trust that's been built up over the last decades post World War II, that is now eroding. And then I think the biggest, I would say, benefactor of this whole thing is probably China behind the scenes by doing nothing, yet looking like the nice guys now that are saying the right things, doing the right things, and they are the ones who are now signing all the trade deals with all the other companies all the other countries that are defecting from the United States. So I'm seeing that play out. And I think long term, the United States it was already, I believe, on a global slowdown. But I think what's occurred in the past 6 months, in particular, and the past year, has speeded up the process where it's now a declining power. And not that they're going to disappear anytime soon, i.e., the US dollar is still going to be around for a long time. But in terms of global influence, global impact, I think a lot of the damage has already occurred from this new Trump second presidency. And therefore, all the old allies are now turning away from the United States and doing deals and doing, to not only survive, but post-US period, how are they going to prosper in this post-US period? And they can see that the writing's on the wall and they're now negotiating.
So what's happened in the market over that time, Terry?
In the markets, despite what's occurred, you would think that the market would actually drop quite dramatically, but it hasn't. So in actual fact, since April, when Trump came back into power and did that so-called Liberation Day, the market's actually the market did pull back quite dramatically, but since then it's gone up by about 40% from that point in time. And since we last spoke, the market's gone up another 10 more percent. And this is because all the companies that are reporting are still reporting great numbers. However, although the market's gone up by 10%, it's gone up by 10% only because of the tech sector and the artificial intelligence, the AI sector. If we strip away all those, I'd say top 10 companies, the Googles, the Metas, which is the Facebook, Microsoft, Apple, if you take away those top performers, which is really the tech space, the market has actually been quite flat overall. But yet people see the market's bubbling up and they think that the market overall is very healthy. It's actually not. It's only healthy because of all the technology investment that's going into the sector. There's a couple of $100 billion already in the past year. So that's gone into the sector, and that's correct. That's the thing that's been holding up, in a way, not only the market, but also the globe in terms of money flow and reinvestment and also employment too.
So you mentioned tech and AI and pharma and retail being opportunities 6 months ago. How have you and your members taken advantage of that over the time, Terry?
It's actually done very well because, as you know, Touch, we go for where people don't want to go. We go for the bad news. So whenever there's good news, our philosophy is always good news gets priced in, and a lot of people try to catch that great news story. But the problem is when they do that, they're now overpaying for those opportunities, and we don't want to go there. So if the opportunity is still there, it might be a great news story, but it needs to be priced correctly as well. And back then, 6 months ago, when we were talking about the tech sector, investments were still going in, but it was okay. But one of the big sectors that we found that was very cheap at that time that nobody wanted was the pharmaceutical side, especially all the big pharmas, the likes of Merck, Pfizer, that was sold down. So we saw that as an opportunity. And I even told our students, our members, that this would probably be one of the lowest risk type opportunities out there because it looks bad now. Yes, the stock has dropped by 30%, but it is so cheap and undervalued that buying at these prices, there's only one way up, and it's up. And I just don't know how long it'll take. And in the last 6 months, all those stocks have actually bubbled up quite dramatically and beyond the 10% I spoke about, which is the overall market. They've gone up by 20 or 30%. The Mercs, when we bought it, was very cheap. And now some of the positions in the Merck that we bought are up 40% in that 6-month period. Are they now cheap? No, it's not. So the opportunity that 6 months ago was there, but now it's gone. So where are we going? We are still finding pockets of opportunity where some of the stocks are still being sold down, and that's where we want to go. But is there many? There's not a lot at the moment.
So prior to hitting record on this episode, Terry, you mentioned perhaps the construct of an overheated market crash.
Yeah.
What's your outlook, and what do you mean by that?
My outlook is that I'm expecting, again, I don't have a crystal ball. I don't know when it will happen. I always look at the data itself. So until the data tells me, that's when we'll switch dramatically. But I already am seeing that in terms of valuation, where overall there are so many companies, and even, let's talk about a company that most farmers will know well, John Deere. There was a point in time last year that John Deere was sold at about 30% of what it's currently priced at. And now John Deere is priced at almost 30 times earnings. So in other words, every $1 million worth of John Deere net profit, the market is willing to pay 30 times or $30 million for that earnings, which is a lot. At one stage, John Deere was priced at about 15 to 20 times. That's when you can see value there, especially for a quality company like John Deere, which most farmers do rely on. So when you see that, you know that overall the market, not only in the tech sector, but other sectors like farming, is also getting expensive as well. So my expectation is that between now and the end of the year of 2026, I already spoke about it towards the end of last year, that the opportunities aren't as plentiful anymore. And therefore, what one should probably do is start cashing up and making sure that you are prepared, because cash is king. When the market does take the tumble, you don't want to be caught out like a deer in headlights. You want to make sure that you're prepared. So when that happens, you're not a spectator that just sits on the sidelines and you're unable to do nothing because you've got no cash ready to go. So I'm expecting definitely a pullback. How big? I don't know. I do think that it will be quite large because of where the market is currently at. And it's just selling down. So we were happy with 17. That's what we achieved, almost about 17% last year. A lot of our students also did between 15 and 20% last year. But then the prior years, not just last year, but the prior years, 2024, 2023, 2024 was a 24, 25% year. 2023 was a 32% year. So we've had multiple 20% year, 30% years already. And we can't expect that to keep on bubbling up away. So the only way one can now achieve another, say, 20 or 30% year is to make sure that you're cashed up. And when the time comes and everybody is panicking, selling down, you're coming in at half price and then buying up cheap assets. And if you are able to take advantage of that, that's when you're going to have another big year as well on top of that. Because when I talked about the 32% year, that was only because it was post-COVID. The previous year, the market dropped by 20. We didn't do nowhere near as great as what we normally do. We only did 12. But I say only, the market did minus 20, but we did positive 12. So we still beat the market by 32%. But then we had all this cash ready to go. So then we went in. So the year after that, we did 32% because we were cashed up. So generally, if we can get prepared, post-crash years are going to be the years that one can do very well, but also do it with very low risk as well.
They're amazing results, Terry. Congratulations.
Thank you.
What's behind that overvaluation from your perspective?
I think definitely a bit of hype in terms of where AI and artificial intelligence is going to take us. The amount of investment or capital expenditure is actually quite crazy, because just looking at one company, Meta, Facebook, that a lot of our farmers we all use, etc. Last year they spent, I believe it was about 115 billion into AI. Forget about not including other investments, but they've invested in improving their AI systems within Meta platform itself, 115 billion. This year, they're on track to spend, I believe it was 190 billion. So they've bumped up even further again. So can you imagine a company, Meta can afford it, but they've spent 115, taken 110, 190, all up in 2 years, outlaying 300 billion into AI expenditure. So a lot of that expenditure is going in, and whether that's going to pay off is entirely different story. Maybe they're just doing it so at least they can maintain their position and not accidentally drop back by accident. Because if they did that and they drop back and the market found out, they will be punished dramatically as well with their share price. So maybe they're doing that just to keep up with the Joneses. And along the way, they'll probably have both good investments and bad investments. But companies like Meta, they can afford it because they are very profitable with their Facebook ads. So the likes of Meta, Google, when they spend that type of money, it's okay. What I'm more concerned about is companies that are in startup mode. They're still new to the market. They're maybe a couple of years in, and they're trying to keep up the pace, but spending that type of money. And maybe in 3 years, probably won't take that long, but let's say 1 or 2 years, then find out that all that expenditure that went out there, the return that they expected doesn't come back. And that's going to come back and bite.
Terry, you talk about just cashing in a little bit so that you're ready for the post sort of decline opportunities.
Yes.
Which sectors do you think are the ones perhaps to cash out of? And, to what level are you and your members cashing or setting your war chest?
Yeah, that's a great question. I'll just explain what I'm personally doing. So we are seeing a lot of the tech investments we made last year or the last 2 or 3 years we went very heavy into the likes of Google, Facebook. So we held very large positions and we bought them over a 2-year period, maybe 10 times on these big ones. And what we are seeing though is that we're seeing the likes of, say, not only Google, Meta that I mentioned, but also Apple. They were one of Warren Buffett's biggest investments, and we followed suit and we went in quite and established quite a large position in Apple. And Apple was at one stage selling at almost 35 to 40 times earnings as well. And we've cashed out of that because we could see that their sales numbers, their revenue was no longer growing. In other words, they were not selling every time now the latest iPhone that came out. They were just keeping pace. They were no longer selling out beyond expectation. So their revenue was sort of stuck. And we could see that it was slowing down. Warren Buffett probably saw that. He sold out, I think, 75% of his position in Apple. And that was, in that 60-year time frame out of Berkshire Hathaway, Apple ended up being his best investment ever in terms of dollar-wise for Berkshire Hathaway. So we've sold out of Apple, also scaling down, selling down the likes of even Meta, also Google, and a couple of companies that a lot of our farmers probably don't know, but behind the scenes, they're the ones that we do use, is the likes of ASML, a Dutch company that produces the machines. They build the machines that enable the companies that make the microchips, basically TSMC. These machines control about 80% of the global production of microchips. And we've owned ASML for about 2 years, and now they're going way overvalued. So we've taken that opportunity to actually sell down and locking in between 100 and 200% capital gain in that 1.5, 2-year period, which is amazing, really. And that's what I mean, where when we bought it low, but it's gone up way too fast, and therefore the justification of that price means that the company needs to continue growing at that pace, which it won't. So we're selling down those type of companies, and also even TSMC that I mentioned as well, that without them, it's the infrastructure. So without them, the likes of Samsung, Apple, even Amazon, the mobile phones we hold, the PCs we hold, we wouldn't have them. It's because these companies control the market. So that's where we want to go, but these companies are now getting quite overvalued, and therefore I'm selling down is what I'm doing. As of last count, the cash position, what I'm currently on is about 41, 42%. So it's been the highest for a long time. And then, people say, are you cashing out too fast? All I'm doing is just cashing out on things that are overvalued. Things that are still undervalued, I'm holding. Like, I'm not panicking about the market overall. There are still sectors of the market that are still undervalued, but the ones that I'm cashing out are generally the tech side, because they have gone up by 1 or 200% in the last year alone because of AI. And it's getting to a stage where it can't justify the price. So it's almost like analogies like a farm that's worth 5 million, someone's offering 25 million for it type thing. So would you not sell the farm if someone's crazy enough to offer that type of pricing? So you just take advantage of that. And then when the time comes back, pretty sure we can always buy it back at a cheaper price. So that's all I'm doing on this side.
And what sectors are the ones that you think are stable and worth keeping a position in?
I think that the ones that are still cheap, there are some certain things like the retail sector that has been sold down. Some of them haven't recovered. So, and I'm not talking about the whole sector itself. Like, for example, I don't know if you know of Deckers Outdoors. So Deckers, they produce the Ugg boots, the Hoka shoes. So a year and a half, 2 years ago, they were sold down. The stock got pummeled, and the numbers, however, kept on producing great numbers. So they were still selling more than ever shoes on a quarterly basis. So we started buying in, and that stock went nowhere for like 6 months. And all of a sudden, only in the last 2 weeks, somehow the market's seen the numbers, and all of a sudden the stock jumped up by 20% overnight. So this is when I say that there are certain stocks, even within the sectors, that don't get the attention, but they're the ones you want to go towards and pick them up on sale. And then when eventually the market does recognize its value, that's when the market and the rest of the world then hears about it as well. So where I'm seeing is certain retail, like even one Lululemon, which is a female apparel sportswear. So they're still sold down, just like Deckers. They haven't been recognized in terms of value. The numbers are still great. And I would say some of the larger pharmaceuticals like Novo Nordisk on the weight loss side, they're still not recognized. The numbers are still great, but yet the stock has been hit hard like Merck, but it hasn't recovered.
Thanks, Terry. I'm just reflecting that so many of our listeners might have their investments placed through a managed fund, be it inside or outside of a self-managed super fund. How can they influence how the funds are invested And what questions might they need to be asking their advisors to help make
Mm.
sure that they're prepared for what you predict is coming?
Yeah, I think this I think is going to affect the majority of the listeners here, where if you don't have a self-managed fund where you can actually control the level of cash you have. If you've got a self-managed fund, that's great because that way you are in control of how much cash you want to hold. If you are investing directly with shares, which our members are, then you can sell down as required and then make sure that you've got a certain level of cash as well. And I talked about myself having 42% cash. I also want to, on a bigger picture as well, is to let all the listeners here know that even the great Warren Buffett, who's just retired as of December 31st of last year, before he left, he was selling down the portfolio. And as of, I think it was November last year, I don't know what the latest figures are, but as of November last year, Berkshire Hathaway, they were holding about one third in cash, which amounted to about I think it's about $360 billion worth of cash. So he's sold down Apple, hasn't been able to buy anything of significance. So he's holding that amount of cash, not because he wants to, it's because he sees no value, but he sees overvaluation and he wants to take advantage of the next downturn as well. So not just myself, but also the big players like himself, the smart, what I call the smart money, they're doing the same thing. So, if Berkshire Hathaway, they're worth about $1 trillion market capitalization, but they're holding almost 40% in cash themselves. So it's taking that a page from the playbook of Warren Buffett. We should also be mindful that there's something that he's seeing that is going to reflect. And I can see that too, the overvaluation, hence why we're doing this right now. So going back to your question, Jeremy, if you were managed by someone, i.e. you've got an advisor, just ask them that question. Like, what's your view on the market? And are you currently seeing the market as being quite overhyped and overvalued? And see what they come up. If they literally come back and say, "Oh, not that I can see," there's a problem because the market overall has bubbled up dramatically in the last few years, and it is getting expensive. So that is a problem. And question, why do they not see it based on what they're hearing today? And probably I say rattle off some of the ideas that we're talking about and see what they say as well. Because a lot of the advisors, what they do is they do read reports from the institutions, and that's where they're getting the information from as well. Their institutions sell information, and then that's how they make their money. So therefore, they may not be getting the honest type answer out there. Because really, to me, if what you would want to hear is that they are concerned, but yes, they're concerned, but then ask them, if you are concerned, are you planning to take with everything that's happening around the world?
A related question could be, what cash position do you think we should be holding over the
Yes,
next 12 months? And if they don't say something like 20, 30 or 40%, then that might be another alarm bell or another
yes.
reason to reflect.
Yes. Yeah, correct. Yeah, and I think also, if let's say if you don't have an advisor and you've just got super funds that are managed by a super fund like Host Plus, etc., I think what action one can take is firstly find out, I think, the performance that they've had over the last few years, see if how they perform relative to the market, but also what fund they're actually in. Are they in a growth type fund, which means that the majority of their investments are probably domestic and international shares? I'd probably say 80% of it. And if that is the case, then find out if they wanted to switch over to a bit of cash or into a more of a balanced fund, a lower risk type fund, because now would be a good time to do it. What is that process? What are the the forms that need to be filled out, and the time frame that it will take? Because you're better off being prepared with those forms and the logistics of it right now, knowing that when the time does come and you want to do a switch, you're not caught. The listeners aren't caught by surprise that they see it over the news and now it's already too late.
Thanks, Terry. So we've talked a lot about global stocks, more locally, Australian stocks and
Hmm.
your view of the Australian market. Is it similar or different?
I like to trade the Aussie market. I don't like holding the Aussie market. And the reason is because there's only a handful of global Australian companies that are global. The BHPs, the Macquarie Banks, the Cochlears, the CSLs, there's really a handful. The rest are very domestic. So they're blue chip domestically, the CBAs, Telstras. So that way, what I say is that they serve our population of 27 to 28 million people, and that's their profitability, and their profitability can't jump beyond that. because that's all they serve. Funny enough, a lot of our banks, even our Telstras, they've tried to go overseas, going to Asia, etc. But they've always failed, lost a few billion, and they've come back for some reason. So somehow we don't know why that a lot of our great Aussie companies just can't somehow break into the international market. So from the Aussie point of view, the sectors I'd be avoiding, not even just Australian too, but internationally, is the finance sector at the moment and the banking sector. It is quite overvalued as well. So that's another sector that if you look at their earnings and their pricing, that is a sector that I would probably want to, at this point in time anyway, avoid, because they're very leveraged to the economy. The moment that the economy takes tumble, the banks and the finance sector, the funds management companies, the ones that are listed, they're the ones that will get hit the hardest and the fastest. Yeah. Will they fail? Likely no. We've got the 4 pillars policy. Our banks are very protected. They'll survive. It's no issues there. But it's more of the share price itself not getting caught up with the carnage. What I would say is, if you've got the cash down the track, when that does happen, is actually take advantage of it. That's probably the best time to go back and buy the CBAs, to buy the NABs at those times when they are actually on sale.
Thanks, Terry. So what else do we need to know? It's a different outlook for this year compared to last year. Are there any other tips or insights that you've got to share?
I would say the main thing is just, besides holding more cash than normal, is to just be aware of some of the catalysts that can pull down the market dramatically. Obviously, politics aside, a couple of things that I've actually written down is, in terms of what could tip the market into a tailspin, is I would say that expectations of low interest rates might be over. So that will tip it, because I always say interest rates is a gravity towards share prices, because if interest rates go up, there's another place that retirees, investors can put their money and get a decent return, yet not have that type of volatility risk like shares does, and even property markets. So the moment that the interest rates start climbing up, which I'm expecting that they probably will, to control inflation, the flow-on effects of all the global tariffs is flowing through the system. So the interest rates, both RBA and the Fed, they might, over the coming 6 months, might start actually increasing it. So that could be a catalyst to pull down asset prices, which is property market, but also the share market. That's one thing. The other thing too is, I would say, to see what happens between now and, I'd say, the midterm elections for the United States as well, because that's also a big thing at play, because we've seen what's occurred in Davos a month ago with Global Economic Forum, with global leaders, especially the speech that the Canadian president made, and that sort of united Europe, literally. And they pushed back, and Trump had to actually scale back basically what he said, because Europe was literally on the brink of closing off their economy from US companies being able to sell, which is a big slap in the face. And that could not happen. And that would have lost a lot of jobs as well. So I think that would be the catalyst, like what actually happens between now and November, in terms of, will Trump actually be re-elected and have another few more years of Trump presidency? Or will there be a new government coming in, and will that new government try to resolve things again, like try to remake the relationships that's been lost over the past 6 months? So that's the other catalyst. And then the final risk that I'm probably seeing, for one to be aware of, is with the US invasion of, or the takeover of Venezuela, of the president, that we've all heard over the news. That's almost given a bit of a playbook to China, because they've always had on their mind, by 2027, the goal of uniting Taiwan as part of China. And the main reason for that is not just because of the past history, etc. What they really want is the control of the global chip supply, which is TSMC, the company that we're involved in. And it's a listed company in both the Asian markets, but also US markets, TSMC. And will that occur? Will this military buildup and this preparation continue on, and then go according to China's timetable, but that by 2027, there's going to be a takeover, or a unite, the takeover of Taiwan now finally becoming part of China. So that's the other catalyst as well. And how messy, would that be a smooth transition, or would that be a messy transition?
Okay, thank you, Terry. Really interesting insights. A couple of times a year, you offer, and we graciously accept, put on an exclusive webinar and workshop for our listeners, so that they can learn directly from you about how you value stocks, how you shape portfolios, and how you make buy, sell, and hold decisions so successfully in the equities market. Would you mind speaking to the next one? We've got one coming up with you on the 17th of March, starting at about 7:30 at night. But would you mind speaking to what you cover in that business or that blueprint workshop?
Yeah, we cover quite a lot of things. I generally don't want to just to speak to our farmers. I actually want to teach, but at the same time, after I've taught, I also have exercises to actually do, and then that way you're learning, but you're also doing, and then you get the real learnings by physically doing. Because as you know, you can learn something, but if you don't do it and do it on the spot, you'll forget it very easily. So what we cover is firstly how to look at the market as a whole, the macro. In other words, are we seeing the risk of the market? Is it high risk, neutral risk, low risk? And therefore, should you still be investing or should you start pulling out? And that free tool is available. And I want to show our farmers how to actually use that tool to assess the global market itself. There's a number of tools, but that one tool is very visual and it's a free tool and it can be used almost immediately, literally. Once I've shown you I've shown our farmers how to use it. So that's one thing. The other thing then is once I move into like we understand the world, then how do you actually choose by using a few simple tools, the simple ways of filtering out, 98, 99% of all the rubbish stocks that's out there and just look at those 4 or 5 main criteria of a stock and know that if these criteria are met, the stock itself, generally when you're investing in them, you can feel quite confident that they'll do quite well. So that's the other part that we'll cover as well. And then finally, if we've got time, we'll also look at in terms of the timing. When do you actually get in and when do you actually get out of a stock as well? So that's where generally what I'll be covering.
Thanks, Terry. It is a fantastic few hours. So if you are in the equities markets or interested to be, sincerely, there's no one better at coaching and teaching around these principles and then supporting our farming families to build significant off-farm investment portfolios by strategic and very thoughtful investment in the stock market. So recommend that webinar highly. We'll include details in the show notes. And Terry, thank you for putting that on again for our listeners and look forward to being involved.
No, thank you, Hutch, for having me on your show all the time. And glad to be part of this and add value where I can to farmers. Because I always see that it is really important over the years, because we've been teaching for 10 years now, and just seeing over 700 plus farmers go through our program and start investing, just seeing what they've created over the years, and also seeing how they've created these larger and larger portfolios over time that supplements the farming income when required as well, and knowing that they've also got a plan that down the track, if they do undergo succession planning, they've got something that's also there that's got nothing to do with farming, and it's very different, especially if they've got multiple children.
What are a couple of examples of members you see who have been with you for a few years and are getting some real momentum around building their off-farm investment portfolio? Have you got a couple of examples to share, Terry?
Oh yeah, I know Richard and Kay McInerney from Queensland. And I remember when they came in, Kay was very cautious. She was concerned about, obviously, the risk of the share market. She did have a small portfolio of a few bank shares, and that was about it. But she trusted the process. And now, whenever I'm posting, because we do share like what we buy and sell on a weekly basis, you just see Kay and Richard, like they're always on the live sessions, and they've scaled up as well. They've literally scaled up their portfolio. So that's one farmer. And the other one I know is Ben Taylor. Like he's definitely scaled up his investments in their portfolios as well.
Amazing. And with those members of ours and further afield that you coach and have part of your programs, what do they enjoy? Can you just give a practical insight to what happens when people join up as a client and a member with you?
I think what they enjoy most is firstly making sense of the whole thing, because the share market might feel very scary and volatile and risky. But then when you know what to look out for, it just gives everybody a peace of mind that when they're now investing, they're not gambling. You're actually following a very systemized process that I've used for 30 years. 700 plus farmers have been using for the last 10 years as well. And just knowing that there's this process-driven approach that it needs to tick all the boxes. And if it doesn't tick the boxes, there is enough investment opportunities and cycles that you can miss out on this opportunity and don't worry about it, and not have that FOMO. And at the same time, whenever people down the track, their friends and family like when they give them tips of certain investments, certain stocks, certain shares, then now within 30 seconds, you've got this confidence to literally look at the numbers and just go, yes, it's for me to further investigate, or no, it's not. It just does not make sense financially. Like the numbers just don't make sense and you can let it go. So I think it's that confidence of, and even attending this masterclass that we're going to hold, just having that skill itself is so powerful because it will help not only, forget about the making the money, but it's going to help avoid a lot of accidental financial mistakes by getting into the wrong things accidentally. Because once you've got those numbers, it's very hard to unsee and unlearn what you've learned. Because once I give it to you, if you do go ahead and go, with those bad investments anyway, you know for a fact yourself that you're breaking these rules because I'm giving you the rules and you either follow it or you don't. So I think having that set criteria is what farmers most enjoy. And the other part I think they enjoy is as well is seeing not only just once having the confidence to make these small investment decisions, but over time, knowing that they now have a plan. So they start scaling up the portfolio beyond what they thought possible and then also self-managing their super fund and a lot of our farmers sacking their advisors too at the same time.
Terry, a lot of us think of ourselves as business owners and farmers, and less so sometimes as investors. What percentage of our time do you think we should be allocating to putting our investment and investor hat on and focusing on building that off-farm balance sheet and off-farm portfolio?
I think one needs to definitely start. But then on the other hand, people say, oh, Terry, I'd love to be a full-time investor. What I do want to explain to you is that investment, if you have it process driven and systemized, it doesn't take that much time. Where a lot of the time does come along is the initial phase of actually learning a brand new skill and setting up all the processes and setting up all the systems on the PC. So once you've got that set up, that's where the time comes along because the rest of the time when you're physically investing, I would probably say on average, it's about 20, 30 minutes per day on average. Some days when there's no opportunities, there's no point staring at the screen. When there's no opportunities, it might be 5 minutes. Just shut down the computer and go and tend to the farm. So I think thinking about it is important that we do spend a lot of time preparing and at least getting started. So I think that's the important part. But in terms of utilizing time spent once everything's systemized, I don't think there's that much time that's required on managing a portfolio because we don't need to be full-time investors to obtain a decent result. And even myself, with all our students running, quite a large portfolio now with for the family, it really is only on average half an hour to an hour a day, and that's managing the portfolio plus also looking after our students as well at the same time.
Amazing, Terry. In agriculture, we've got an asset and we're happy to leverage it in order to achieve more scale, buy more land or leverage our
Mm.
balance sheet to, expand the intensity of our system. In property, we get to buy a residential or a commercial property and gear it up to 80% or thereabouts. If I've got $1 million invested in shares, what's
Yep.
your view and appetite on gearing against that to achieve more scale invested in the equities market?
Yep. I would go against in terms of taking the share portfolio itself and let's say obtain margin lending alone. Because yes, the banks will be happily to give you sometimes 50, at least 50 to 60% of that. But then what that does is it gives them the ownership and therefore down a track, which I've experienced in the past 30 years ago, getting margin called, which is something and a phone call that nobody wants to get. So I think if you want to do safe gearing, and I talk to our farmers in terms of safe gearing, it's utilizing what we have on the farmland or property, and it doesn't have to be geared to use that land, the farmland to buy more farmland or more property. You can actually use that same equity to also diversify and go into the share market as well. So not necessarily using the share portfolio as leverage itself, but knowing that you've got that share portfolio, that's great. But then having the gearing using property equity instead, which could be farmland equity, to actually gear towards buying a share portfolio.
Great. Terry, always fantastic to connect. What's your summary on what we should expect or might see over the next 12 months and how best to prepare?
I think the summary is that to be aware of what's happening around the world, we're seeing all the news, the good and bad. forget about the news, let the data tell us the picture. And the data at the moment is telling us that a lot of the share market itself, plus a lot of the companies, are now overvalued. And it's important that if you manage your own portfolio and you manage your own super fund, great, you've got full control to make sure that you're not getting too greedy and ensuring that you're selling down to ensure that you've got this large amount of cash. So when the time does happen, you can take advantage of that. That's the main thing, and not be a spectator on the sidelines. The other thing too is that if you are managed by somebody, is to take the front step and find out what are you physically now invested in. So at least find out, where is your money, and if you're fully invested in a growth type fund, which means that it's primarily almost all in shares and there's hardly any cash, then maybe find out what are the steps if you were to either transition the fund to another more lower risk fund at least for this short period of time, because you can always swap, switch and change anyway. Find out what the logistics of that is, and even find out from the fund itself, could you allocate a percentage into cash? Because if you could, then life is much easier. You can stay in the same fund, but then sell down some and then have that as a cash component anyway, because it's that cash component that will hedge against the pullback that the market's going to have in 2026. But more importantly is that having that cash to then go into the market when the whole world's panicking.
Thanks, Terry. Really appreciate your view on the global market and your outlook for 2026 and your direction on what people might do to prepare and make sure that they're, as you say, not passengers in this, but they're ready and poised to make the most of opportunity. Really appreciate your time. To everyone listening, recommend Terry's webinar upcoming on the 17th of March, and we'll include those details again in the show notes. Terry, thanks for your time, mate, and great to see you.
Thanks, Hutch. Pleasure as always.
Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.